Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only advisor. Today we're talking business structures. Specifically, we're discussing why you may or may not want an S-Corp for your private practice. While you might work with a CPA and they may tell you you need an S-Corp, it's important to understand that the S-Corp isn't for every practice. An S-Corp provides some wonderful tax-cutting opportunities, but it isn't a tax avoidance vehicle. By using an S Corp, you're reducing your ability to take out other deductions. When you haven't reached certain thresholds, this can actually increase your taxes or hurt your future income. I'm going to explain how. Let's get started. The reason your accountant or CPA is telling you you must have an S Corp is because of how it can reduce your self-employment taxes. Self-employment taxes account for Medicare and Social Security and equal 15.3%. When you work for an employer, you pay half of these taxes out of your paycheck. Your employer pays the other half. But you work for yourself, so guess who pays the other half? That's right, you. When you operate an S Corp, however, you designate yourself as both the employer and employee of the business. On the wages you provide yourself as an employee, you pay the self-employment taxes on that money. But you can also allot a portion of your profits as gains for investing in the business as the employer or owner. This money isn't taxed as regular income. Instead, it's taxed at 20%, and you don't have to pay self-employment taxes on it. This can create huge savings, but there are catches to all of this, and it's important to understand. So let's dig into those. The rule for what you pay yourself as an employee is left vague by the IRS. Instead, it says you have to pay a reasonable amount for the role you have. This essentially means you need to pay yourself comparable to your peers. But what if you don't make enough money that's comparable to your peers? Well, then the value of an S Corp will drop until you make a little more. It doesn't mean you won't use an S Corp in the future, but for now, the LLC will probably do. There's another issue with reducing the amount you pay in self-employment taxes. This is again for Social Security and Medicare. If you reduce the amount you pay into Social Security, well then guess what? You'll receive less in Social Security. For some, that's completely fine because the amount they pay in self-employment taxes gives them enough in Social Security benefits anyways. Social Security taxes stop once you make $160,200 in 2023. These numbers typically go up with inflation. But for others, they may need to rely on Social Security funds in the future. If you're not giving yourself enough money for that future, then you'll feel it when you're older. You want to balance what you're saving in taxes with your future benefits. It's not an all or nothing thing. Instead, it's determining what you need and how much of that will come from Social Security. Then, determine what you'll pay in Social Security taxes today. Depending on the state you live in, the yearly filing fee for an S Corp may be significant. Not only that, but to file as an S Corp when doing taxes, it's much more expensive to hire your CPA. Some less than honorable CPAs will even encourage S Corps in situations where it's not needed, simply to create a higher fee come tax time. And you will almost certainly need a bookkeeping service to keep your documents organized to ensure you have a clear reason for paying yourself a certain salary. The IRS, after all, is much more likely to audit an S Corp than an LLC. For all these reasons, if you're not saving enough in self-employment taxes, don't worry about the S Corp. The fees become worth it as your business revenues grow. When you have an LLC, you're taxed on all the revenues that your business makes. You get certain deductions, and one of the big ones is Qualified Business Income Deduction, or QBI. This allows you to essentially take the revenue and cut it by 20%. That's the deduction. It's huge. But when you're an S Corp, only the amount that you make as the business gets the QBI deduction, not your salary. The salary counts as an expense to the organization. So if you make $150,000, $100,000 of which is your salary and $50,000 is your profits, the QBI is brought to the $50,000, not the $150,000. It still may be worth it, but you have to do an analysis to determine if it is. This is a very simple example, and there are tons of caveats to it. But you need to make sure your tax advisor evaluates those caveats when concluding the S Corp is right for you. The good news is that no matter what stage your business is in, you can use the S Corp when you are ready. By having an LLC or PLLC, You can let the IRS know that in the current tax year, you would prefer to be treated like an S-Corp. If you know the year is going to be a little slower, then you can instead stay as an LLC. This gives you some control over what structure you use. And it provides protection in case one structure would actually cost you more. Then, as you grow, you can always shift to an S-Corp on a more permanent basis, if you need it. What business structure do you use? Tell me why in the comments below. This is Thinking Solo. I'll see you next time.